Hello, people of the internet. And today, what we're describing to you, loyal internet fans, is the series of articles I wrote about bot on Huobi. Huobi is a Singaporean exchange that does a lot of derivatives volume. Now, the reason that I wanted to use Huobi versus the bot that I already had, which was on FTX, is because the coins that it was trading on FTX were much more esoteric, which means that we could only trade a certain amount of leverage. Now on Huobi, we have much less esoteric coins instead of coins like Comp or Cream or FTX. So we can actually trade with more leverage. And we also know that there's higher liquidity per coin that we're trading on Huobi, which means that there's less risk of a drawdown trading these hedged pairs. The coins also have more trading pairs in the sense of futures versus hedge, where FTX simply that for a given coin like Bitcoin or Ethereum, or Ether rather, you have all of these additional pairs. So for Bitcoin, you have Bitcoin swap as well as four different futures entirely. The bot identifies which futures versus swap prices exist above a threshold in annual percentage yield, then determines which opportunities are over the average of the opportunities above that threshold. Out of this list, it calculates the percent of each opportunity out of the total percents, and then creates a list like BTC 20%, ETC 30%, ETH 50%. It allocates equity on the account accordingly at leverage. And it also is smart enough to know how to get out of a position over time. Notice there's actually some balance right now on the exchange account on our Huobi account that we're doing development on. Which means that I noticed that it was time to get out of a position and get into a new position. So over time, two things can happen. The price can converge between futures and hedge, realizing gains and lessening the relative percent opportunity. So we're closing position percent relative to the realized gains. Or the price can diverge from futures and hedge, realizing temporary losses, increasing the relative percent opportunity, so that we're putting more of our equity into these opportunities versus the other ones to realize these gains later. So even when it's going down, it's going to go up. Whatever the case above, the prices will absolutely converge and become more equal over time, as the properties of the futures contracts dictate that they must equal the underlying when they expire. This certainty means that our adjusting our balance over time will capitalize on the APYs available, the yields available, over and over again, sometimes in the length of 30 minutes in and out. And I actually have a video proof here for you that describes that. And then we just rinse, wash, and repeat. So in this first article that I posted, basically I give you instructions on how you can run your own bot for free just by using my referral link here, by emailing me, and then you can go ahead and use my bot to run your own funds. You just give me the API key and I will run it. The person running the bot right now had said, thanks for sending the link. He says, is it trading frequently enough to unlock better fee levels? And that's absolutely true. It is trading enough. If we had about $5,000, maybe $10,000 in the account trading at leverage, we would have enough leverage, or enough trading volume rather, to do about $30 million US dollars monthly volumes, which is enough to unlock the market maker tiers, which are actually fee rebates on this exchange that normally doesn't have fee rebates. And you can go ahead and take advantage of that, and you would be making even more money than the bot is making right now. And what did the bot do? Well, you can see that I put it on a live stream here, and my friend Natho joined and then left for half an hour and came back. After he came back, he says there's three US dollars profit, almost four, which is correct. It's about 1%. I've written all these other articles that you can review, like how the big kids make a shit ton of guaranteed risk-free money. I actually spelled guaranteed wrong here. Same idea, different tack. Huobi MM futures cash and carry instead of FTX. So that's a little bit of the backstory. We changed the coins that we're operating on from this list here to this more advanced list here with more opportunities involved. And that's a good point. None of this constitutes financial advice. Where did that just go? None of this constitutes financial advice. I'm not qualified for that. I cannot and will not assure or imply that we can predict the future, and trading at leverage can be extremely risky. Trade only what you can afford to lose. So in case I didn't really describe what it does, there's this new article that says on the turn of Huobi's 24-hour interval to show new and updated stats on their verifiable interface, we sit at 3.57% returns. That's in less than a day. That's enough to bring our total profit and loss, including the first day doing development to get this thing working. Read the entire sunk cost of dev. It brought it positive. It has more than a third of a day more to work today, although I did notice it is just dancing around the $0 mark in returns here after running for the last 7 hours or so. So we might see the returns be around zero or somewhere between zero and that 3.57% we realized yesterday. So what I mean is that during the first day, during development, this was down 3.25% or so, and then on the next day, at the end of the day when it turned 7 hours ago, it was up 0.22% in total, which is 3.57% for that one day, which is kind of fantastic. It's about $14 it was up in the course of 24 hours. So then we're just going to watch it gain some more over time to get to be another very profitable day. There's no really way to assess how profitable the days will be or how much profit it could make over time. But we can get a good traction under our belts and see what it does. So do you want to run it? You can actually look at that other article that describes how to get hold of me with your API keys. So how does it work? What is futures cash and carry arbitrage? According to Investopedia, futures cash and carry arbitrage is a market neutral strategy combining the purchase of a long position in an asset such as a stock or commodity and the sale or short of a position in a futures contract on that same underlying asset. It seeks to exploit pricing inefficiencies for the asset in the cash or spot markets and futures markets in order to make riskless profits. The futures contract must theoretically be expensive relative to the underlying asset, or the arbitrage will not be profitable. And the reverse is just doing the opposite of that, where you short the asset and long the futures position and realize, again, riskless profits in a market neutral strategy, which are what I said were the key takeaways from that. It's non-custodial. I don't take your money. You hold on to it as it is your money on an exchange account where you can revoke API access that we manage orders and positions with at any time, and we cannot withdraw. It's also liquid, where you can cancel your open orders and potentially close positions at any time and are free to withdraw any amount of capital at any time. And that's versus, say, like the renting market, where you put all your money in the house and it's tied up in the house. This is actually liquid compared to that kind of illiquid investment. It's scalable. It would take positions sizes in the tens of millions in equity to have a significant impact on these markets. Even then, the larger the position size in the strategy, the more aligned the markets are to move in that direction, becoming a self-fulfilling prophecy where more and more of the orders and trades would make the prices converge quicker. Bringing your attention back to the word riskless, we hedge our positions one-to-one with the swap and perpetuals markets, meaning that any movement in the prices of futures or the hedge will always, all else remaining equal, factor out to 0% movement in equity. As one goes up and the other goes down, and our longs go one way and our shorts go the other, that means that we're going to be long of futures or short of futures, and then the opposite on the swap, and a movement in price will have no effect on your equity after it equals out. This leaves us with the realized revenues realized from the futures arbitrage opportunity, which is the price percent difference from the downside expiry, when the futures contracts will invariably equal the underlying price. At leverage, this becomes a substantial amount. Take Bitcoin right now as a spot check and a snapshot. You see that swap is trading about $300 less than buy quarterly. So if we buy or long the swap and sell or short the buy quarterly, by the time the contract expires, we'll stand to earn about $300 per Bitcoin or $3,000 per Bitcoin at 10x leverage. The weekly or bi-weekly contracts up here might be more advantageous after you divide the number of days into the percentage opportunity, which the bot does in real time every few seconds. There's a low barrier to entry. In traditional markets, the minimum to play on futures of swine or oil or whatever you choose is $10,000. Keeping in tradition with Satoshi's vision for cryptocurrency, there's little barrier to entries when it comes to trading crypto derivatives at leverage. In crypto markets, is just $1 and bank the unbanked. To be effectual, which is both effective and efficient, it's about $1,000 that you need among many pairs. We already went through this list here. And that's basically that. So if you did find this video, go ahead and review the other videos that I'm going to include in the description. Yeah. I mean, we'll just include all these in the description. So thanks so much for your time, and you have yourself a wonderful day. If you want to get a hold of me, read the article that describes how to send me your API keys, and we will get started with one of these bots. All righty. Thank you.